Welcome to Banking and Finance Television. Today I speak with Peter Farley from IDC Financial Insights on the topic of uncertainty, finance and risk. Hello Peter, welcome.
Good afternoon.
What struck me in the white paper you co-authored is that there might be an upside to risk. The normal thing would be that a risk is there to be mitigated, and if you know the risk, there's no risk anymore because it is to be mitigated to any cost. Where would you find an upside to that risk?
Two elements to your question, I think, Jeroen. The first is that historically risk and compliance was seen as an obstructive part of the banking industry. These were the people that always said, no, you can't do that. Moving forward, risk is becoming an integrated part of a financial services organization that can have positive implications for the business if it is done in an integrated manner with the business interests at heart. Clearly, the old way was not the right way to go, in that an isolated approach to risk meant that people didn't have a true picture of the business risk. Now, banks can't operate without taking risk. That's what they do. They must be able to understand those risks and its implications if events change from the original investments or products.
Yeah. I think risk-taking and assessing risk, understanding risk, it's in the heart of every bank. And of course, that's one of the core competencies of the banking industry. Now there's a lot of issue about the risk management, but what the past tense of risk is, of course, the turbulence we have in our financial markets. Seizing the upside of risk would mean seizing the upside of turbulence. How would you react as a bank, or maybe as a risk manager of a bank, to these turbulent markets?
I think the banks have to look to the kind of risk appetite that their customers and their shareholders are willing to tolerate. I think that recent events have shown that the tolerance of risk is fine while people are making money as growth is generated. And clearly, with banks generating 20% plus returns on capital, everyone was very happy. Now, with hindsight, those returns were unrealistic and we'll probably never get back to those days again. We've seen a little bit of an anomaly recently because of the impact of cheap money from central banks and governments that are supporting the banking industry, but that's a bit of a one-off. We will return to some sort of normality, lower expected returns on assets, and lower risk appetite from many who are customers and investors in financial institutions. So people accept there's risk, absolutely, but they want to be demonstrated that risk is being better managed and understood by the people they trust their money to. So that element of trust is being questioned right now.
Okay, I already mentioned the white paper you co-authored. One of the key learnings of that white paper is the integration of finance and the risk function. Can you elaborate on how banks should do that?
Yeah, absolutely. I think there's some simple steps, and integration is key. I think there are two aspects to this. One of the easiest examples is that in most financial institutions, looking at complying with the Sarbanes-Oxley requirements from the United States was handled by the Chief Financial Officer's office and team. The requirements of complying with the Basel II capital regulatory implications rested with the risk management team. Now, clearly, in doing both those exercises, a lot of duplication occurred, a lot of the same information was required, but they were handled by completely different entities within the banks for different purposes. First of all, it could have been much more efficient if one team had actually looked at both. And they may have actually learned lessons which were to the benefit of the business if they'd actually talked to each other. So that's one of the main reasons going forward. I think the other aspect is culturally within the organization, risk was compartmentalized and done in a tick box fashion from the bottom upwards. So people had different functions, different jobs, and as long as their risk role and their risk responsibilities were ticked off, the next layer of management up would then check, and it would carry on up to the top, who would then say, we're risk-free because everyone's ticked the right boxes. Clearly that wasn't the case. So now a top-down risk management approach has to be integrated with a bottom-up functional risk approach. And that's where the culture of risk assessment and risk responsibility has to be demonstrated from the CEO and the board through the organization. And a lot of that has to do with the fact that it's not just things like credit risk or liquidity risk or counterparty risk, it's reputation risk. And the banks realize their reputations have been shattered as a result of recent events. And many senior executives have ended up either being arrested or being driven out of the industry because they've been seen responsible for what's happened in their institution. So that's focused a lot of minds at the top of banks.
Yeah, I think you're right. There's a lot of focus exactly in the minds of CEOs and board members on the risk and the assessment of the risk. Risk might become a hygiene factor for a bank, but it should be some business driver. If you would integrate the finance and the risk function, don't you think the risk will be a hygiene factor and not an opportunity driver?
Not really, and I think you don't necessarily integrate them. I think you've got to make sure that the two are in communication with each other. There's got to be dialogue between the two departments, and they must ensure that they're both working in the best and the same interests of the bank's overall business development.
I'm sorry to interrupt, but do you think then on a higher organizational level it should be integrated to one person or to...
No, I think the CEO provides that integration. I think, though, that the role of risk has to be promoted to an equal level of responsibility as the CFO. And in many organizations, the CRO did not have board representation. He would either inform the CEO or the CFO of their risk assessments, and that would be relayed into board discussions. I think more enlightened financial institutions are embedding that risk responsibility at board level, which is a step in the right direction. But I think that historically a lot of bank business plans and remuneration plans were based around the P&L and the forecast of the P&L and its consequent impact on earnings and dividends and so forth. Now I think that if you have a risk-weighted adjustment or risk-weighted capital analysis and look at risk-weighted returns in the bank, your P&L will flow from that. You will be profitable if you get the risk decisions right.
Yeah.
And therefore, if you get that capital allocation correct and the risk management correct, the profits will flow. And therefore, you need to do it from both ways. You've got to do your P&L analysis, but you must do your risk analysis as well. And I think that's going to become more incumbent on a joint decision-making, integrated approach to business strategy with both the CFO and the CRO in the future.
Okay, thank you for the interview, Peter. Thank you for watching Banking and Finance Television, and see you next time.